Hello guys, welcome to Investment Research. You know that feeling, right? That sinking feeling when you open up your brokerage account and it's just a sea of red. It's stressful, it's confusing, and it really just boils down to one simple question.
Look, it's the right question to be asking. And even though it feels incredibly personal when it's your money, the answer is usually found by taking a step back and looking at the bigger picture. So in this explainer, we're going to give you a super clear framework to understand what's actually driving the market down, so you can go from feeling anxious to actually understanding what's going on.
We're going to tackle this with what I like to call a zoom lens approach. We'll start way out with the big macro picture, then we'll zoom in a bit to the company level, and finally, we'll focus on that all-important human factor, the market mood. All right, let's dive in.
Okay, so let's start with the widest view possible. A lot of the time, your portfolio is dropping not because of anything your specific companies did wrong, but because of these massive currents in the global economy that just kind of pull everything down with them. And right now, one of the biggest currents is a word we are all probably sick of hearing: inflation.
So what is it, really? Simply put, inflation just means your dollar buys you less tomorrow than it does today. And for investors, that creates a ton of uncertainty. I mean, think about it. If the cost of everything from steel to software to shipping is going up, well, that can seriously eat into a company's profits, making their future look a lot less rosy. And that uncertainty, it makes the market very, very nervous.
So what's the main weapon in the arsenal to cool down a hot inflationary economy, especially here in the US? Well, the answer lies with the Federal Reserve and its control over one very important lever: interest rates. And this kicks off a really clear chain reaction. The best way to think about the Fed raising interest rates is like they're hitting the economy's brake pedal. All of a sudden, it gets more expensive for companies to borrow money to do things like, build new factories or hire more people. This naturally slows down their growth. And since Wall Street prices stocks based on their future growth, those expectations get adjusted downward, and that can push stock prices down all across the board.
Okay, let's zoom in now. We're moving from the big, economy-wide picture to the individual companies in your portfolio. Because even when the whole economy is feeling shaky, some stocks get hit way harder than others. And the reason for that often comes down to one thing: basically, their performance review.
Every 3 months, public companies have to release an earnings report. Just think of it like their quarterly report card. It tells investors exactly how much money the company made, how much it spent, and, most importantly, how it thinks it's going to perform in the future. Wall Street hangs on every single word.
And here's where the market gets, kind of weird. A stock can absolutely plummet even if the company's making tons of money. Why? Because it's all about expectations. If Wall Street analysts were hoping for a company to grow by 10%, but it only grew by 8%, that miss completely shatters the story investors had in their heads. And in today's market, you've got automated trading algorithms that can react to that shattered story in milliseconds, selling shares before a human even has time to finish reading the headline.
Of course, it's not always about that big earnings report card. Other things can totally spook investors and drive a specific stock down. Maybe a huge product launch was a total flop, or a tough new competitor just entered the scene. It could even be a star CEO suddenly announcing they're leaving. These are those micro-level stories that can really hurt one stock without sinking the whole market.
So we've covered the macroeconomy and we've covered individual company performance. But now we have to zoom in to our final and maybe the most powerful factor of all: human psychology. Because you have to remember, at the end of the day, the market isn't just numbers on a screen. It's millions and millions of people making decisions. And those decisions are often driven by two very powerful emotions: greed and fear.
Market sentiment is this incredibly powerful force. Warren Buffett nailed it when he said, "You should be fearful when others are greedy, and greedy when others are fearful." He's perfectly capturing that emotional roller coaster of investing. When prices are soaring, greed just takes over. But when they start to fall, fear can spread like wildfire.
And when fear becomes a dominant mood in the market, logic can just go right out the window. You can have great news about the economy or a fantastic earnings report from a company, and it might be completely ignored. Instead, investors get tunnel vision on the downside, selling their shares just to avoid more potential losses. This selling pressure creates a self-fulfilling prophecy, dragging the entire market lower.
And this, right here, is the crucial takeaway. A market downturn is almost never about just one thing. It's usually a perfect storm. You get these big macro fears about inflation, which then get combined with a few major companies reporting bad news. And that sparks a huge wave of fear-based selling. Each factor just feeds on the others, creating a downward spiral.
So the next time you open your account and see that sea of red, just take a breath. Instead of just reacting to the scary headline noise, use this framework. Ask yourself, is this a macro story about the economy? Is it a micro story about one of my companies? Or is this a human story about market fear? Because understanding the plot is the very first step to becoming a more informed and hopefully a much more confident investor.